Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, December 12th, 2024. It's 12:36 p.m. Eastern Time as I'm starting the video, and in this one, we're going to cover commodities. I'm going to start out with some of my favorites and then just hit on some of the different ones, and I'll include futures, ETFs, both specific commodity ETFs or ETNs, as well as the broad-based ones. Shouldn't be a super long video, but let me just start out here and dive right in with nat gas. This is the 60-minute chart. Typically, the shortest time frame I'll swing trade on, and then longer term trend and position trades, which we still have for natural gas and a lot of the ag commodities. I'm viewing those as longer term trades that I'll look at the daily and even the weekly charts. 60-minute chart. Last update I gave you, I was on vacation and mentioned somebody asked for an update, and I said that natural gas had just come off, pulled back to this 2979 level, so we'll call that 298 level. You can see two reaction lows, and was right here. I said it's if you're going to go long there. Gosh, did we move up since then? I'm trying to remember the last update. I think we were right here at that point in time. Oh yeah, and then I followed up when I got back. That's right. And so we popped up there. We held that level, popped up to this resistance zone where I said a reaction's likely. You could have a tight stop right here on that red line, or just, again, I'm viewing this as a longer term trade. It's basing, I'm going to zoom out to longer term charts. And what we really need to do is break out of about 365 to run. I still maintain my long-term swing target of $5 on natural gas. I'll get to that chart in a second, show you why. Let me just see if I have this marked up on the 6-month. We're about to roll. The futures will roll soon, but right now we're still trading most volumes in this contract here on the Januaries. All right, there's still, you can see right there as well. That's the level that we really need to pop. It's pretty good resistance, and I think natural gas will start to let loose if that happens. Let's take a look at the long-term charts. This is the one that I've been covering all the way out on the weekly chart. And this makes the the bullish case for more of a longer term swing or trend trade. So we had this recent divergent low, very big, nice, clean divergent low. This is what I like to see on the weekly time frame. I look for these divergent highs, like you can see. Let me change the color here, make that a blue tool. There was a divergent high that set the end of that, or marked the end of that rally. You can see my divergence lines here, marked by a divergent low. I measured out the runs, covered this many times in the last few months, and showed you off all the divergent lows. Again, we're going back to 2005, and got every single one covered here, all the divergent lows, and measured the rallies: 224%, 158, 234, 208, 563. Bit of an outlier. That was when Russia invaded Ukraine. So we had some, supply disruptions, and a little worries. But either way, you can take a kind of an average number there, and that's why the current rally being only, with little quotations, only 142% is well below the average of the previous, and we have a much bigger divergent low. So that's why I still think we can shoot up there to $5 and potentially this 650 level. But that's right now kind of the and has been the target I'm looking at. And of course, there's that previous high. So I think if we can punch there, we run, and it should be a pretty quick swoon up, a lot like this. That's usually the final thrust in natural gas, is a unidirectional, get out of the way, strap on, hold on, and with it's very few pullbacks till you hit that target. That tends to be how it peaks, with that kind of buying climax or parabolic run up to the top. And like any trade, not married to it. It could certainly peter out and not materialize. There's an uptrend line right here, potential uptrend line. There's only a couple lines for a longer term, stop on a longer term swing or position trade. And then somebody asked me today a question they brought up in the comment section about seasonality, and my reply was, years back I made a chart, which I only updated today. I partially updated. This is it right here. And it shows, it's a pattern I noticed way back here, starting in, the mid-teens, that in recent years there's been a trend of natural gas prices rallying around year-end, followed by an equally sharp or greater correction shortly before or after the new year. And you can see, so what I did, the dotted lines are the year break lines, 24, 13, 14, 15, 16. Here we are now, and this will be the end of the year here in just a couple weeks. And you can see and I measured it out really from where the rip started, not the entire, just that final surge up. It was a 62% rally followed by an equally sharp or bigger drop, ultimately 31%, 48. So, and in my reply to the comment section, I noticed I got away from this when it stopped working a couple years back, and then of course we had the Russia invasion. Natural gas prices went crazy, so it's kind of affected, if you will, that huge surge in prices somewhat. But we may see a return to that. Right here, for example, you saw a big correction right before the end of the year, and then it started a nice rally before the end of the year, and then the sell-off. So I guess what I'm trying to say, it's not as predictable. Yes, you could say that we've had this big run up into here. However, I put much more weighting on the current technical posture of the chart with support, resistance, and divergences. In other words, that weekly chart we started out on. So could this crap out after the new year, after this big run? Certainly, but we could also just as likely, like we did here, we were going up, we were in an uptrend, and we had that final surge that really started after the first of the year, most of it. So there's that. I just wanted to bring that up because somebody asked about it. Again, being the fact that it's been on and off in recent years with this whole surge after the Ukraine invasion. There was no rhyme or reason here. It just prices got too high and then they collapse. That's the nature of natural gas. It has these big runs and then big drops, and that's that. So that's it. I showed you the levels on the 60-minute chart. Yes, ETF and ETN traders would use UNG. That has again, I take this daily chart with a grain of salt. Only because the fees and expenses incurred in managing and rolling the futures every month in this ETN, which again tracks like all commodity ETFs and ETNs, they use the futures. I trade the futures of the pure play, roll myself, minimal expenses. And so what's going to happen is over time the chart is going to get distorted. You have that decay, if you will. Now, with that being said, a lot of traders trade this, and so you can see I have different uptrend lines. And what meshes with the chart I started out with of the nat gas futures, the weekly chart, is this big divergent low. So that still shows through, and so I again, it appears to me not only that divergence is one thing, but we're also at. Let me flip back to that other chart here for you real quick. We're also at multi-year. Or we're coming off multi-year low, which is support. Remember, natural gas, they can certainly pump out a lot, and they have been increasing the production, and Trump's more favorable to the gas industry. So you have that whole thing, maybe a lot of supply comes on market, but there's also much more use. We can debate the fundamentals all day long. More and more power plants are using natural gas, going to that. It's a cheap source, but all I can do is go off the charts. We can sit here and debate the fundamentals all day. Again, the case that I've been making now for a while, this is as low as natural gas has gotten ever, and going back, in decades. So you're buying a commodity, they're not going to give away for free. They will cap those wells before they lose money on it. They're not going to, sell, get out there and have workers working the wells and, giving it away for free. So there's going to be a floor on just about any commodity. That holds true with wheat, corn, soybeans, and all that other stuff I'm about to get to. So there it is. And again, short term is that 60-minute chart I started with. You want to pop that level. And again, it's the recent highs that I think would be quite bullish and quite likely spark a pretty impulsive rally up to that $5 level. And if things go the other way, well, I've given you multiple levels. You can stop out. I've covered so many entry points and exit points on this, especially on the 60-minute charts, that there's not one entry price on this trade. It's an ongoing thing, in out, mostly long, some shorts, and some side steps after price targets are hit and pullbacks are likely, and recycle back in at lower levels. Okay, enough on natural gas. Another one I'm been talking about for a while, and it's had certainly some little fits and starts, and that's wheat. And we've had on the 60-minute chart, just like natural gas, it appears to me to be bottoming and setting up for a next leg up. I look for these divergent lows, and let me change the color of that tool. And especially at support, and I've laid out price targets. These were all previous trades. Final target hit, divergent high says take profits and or short. Turn around and then wait for the next setup. And the next setup can come in many forms, but typically I like pullbacks to support with positive divergence. That's my ideal setup, and that's what we had here. Divergent low 1. I would have been highlighting it there. We started to go, made a slightly marginal new divergent low 3. And then that was it. And we rallied up, hit T1. At that point back here, I gave you 1, 2, 3, 4, 5, 6, 7 targets. I do have a little caveat, if you will, or an asterisk somewhere in here. Oh, no. Okay. It's on natural gas, but it holds true with wheat. Wheat tracks a little better. There's a little less decay. On natural gas, what I was, the caveat, if you will, or a little asterisk is, always try to use the futures chart, even if you're trading the ETF or ETN, especially on natural gas, because the distortion over time. With wheat, these are still the near-term targets, and if T7, if and when taken out, a lot like natural gas, that recent high, I think it'll open the door to a much bigger move. So that was a divergent low. We went up. We hit my first and second target. When we did so, we had negative divergence, so we came back down, and we've come full circle. There was starting to form divergence there, but most recently, and I'm going to get to futures in a second, we'll show you the same thing here on this 60-minute chart. This is a nice setup. I'm drawing it out for you live here. I already have my futures chart marked up. That's it. So this is the latest. I'm going to borrow this one, divergent low. Let's just take that one, duplicate it, move it over here. Watch, rinse, repeat. So whether you're a swing trader and you just want to go for quick double-digit, low double-digit rallies, gains up here right now, certainly you can say we're boxed in kind of this range recently. So you're talking probably 15% or so up to there. Let me look at it on a 2-hour chart. But I do still maintain these other targets. Why? It's the long-term chart. So when I go to the long-term chart, which I just did on wheat, I know this is what I call a busy board. I have a lot of annotations. We've been diverging. I have to go to even longer term to show you that wheat has now pulled back a lot like natural gas to multi-year lows. And again, it's only going to go so low. If I'm Farmer Brown and I'm not getting enough money for my wheat, I'm going to plant another crop. I'm not going to get out there and wake up at 4:30 every morning and tend to a crop that I'm going to lose money on after putting diesel fuel in my harvester and all that other good stuff. So my point being that these are commodities that reach a floor. They don't pay you a dividend. So as a long-term trader investor, you have to be patient. But let me show you a few more charts. So I do like it. It's set up nice. And I do believe the risk reward on this and some of these other commodities is much more attractive than the stock market right now. And that for what exactly it means, the risk reward ratio, the amount of downside risk compared to upside potential. And like anything else, you want to use stops tactically or strategically, and this one's at long-term support. But again, I showed you the 60-minute chart. So your buy point is going to be a breakout here. In fact, let me show you the futures. That shows a little better. Okay, what we're looking at here is a 6-month chart of wheat futures. That's ZW using 2-hour candles. And this was the last divergent low right there. And that led to, from that divergent low, wheat rallied about 19%. Came down again, just like I showed you on the 60-minute chart of WEAT. I'm going to put a support level here because that's that previous reaction low here in the futures. Right back to that same support level and with positive divergence again. So wash, rinse, repeat. Again, divergence is not a buy signal. What is a buy signal is a break of support. So there's your downtrend line, nice and well defined. Comes off the highs here from late September. Replicate that trend line. So break above there, going to take us up here, first target, second target, third target. And then ultimately, like I said, if we can punch above there, that should open the door to a much bigger move. So this right now, one of the better looking setups. And now we're going to go through some of the ETFs for you as well. So the three big grains are corn, wheat, and soybeans. They tend to move together, and you can see here when I look at corn, it's recently broken out a pretty decent downtrend line. CORN, by the way, is the ticker for the ETN corn. You have this basing pattern here. Really nice consolidation range, potential basing pattern. The 200 days above it. So if we can pop there, we already hit this one. These have all been ongoing long-term trade ideas. Keep making marginal new, still divergent lows. We already hit that first target off that divergent low, and as often is the case, we had a reaction. The reaction took us down quite a little bit further than the previous low, but not too much. And these are still the additional targets here. And so you can see that corn has now taken out this downtrend line right here. And really, if it can pop this level, that's a big level to me. I think it'll run, and I'm going to show you here in a second how corn and wheat tend to move together. So I set a price alert in case I didn't already have one there. And let's look at soybeans first. So YB also set up really nice. We had, as I highlighted back here, big divergent low, positive divergence, had a rally of about 10%. And we came down, made a virtually an equal low. We're right there, slightly lower low. And now we have a nice clean downtrend line right here. Oops, that's not it. Here's my line tool right here. And boom, pop, and we should go up. And again, I've been highlighting these all the way back here. Come down a little more, but the long-term technical posture hasn't changed. In fact, it's only gotten more bullish. So don't mistake bullish technical posture for a bullish trend. I'm very, very aware that near-term, it's in a near-term downtrend. But when you look longer term, soybeans as well as corn, and that's the thing, there's wheat has really lagged behind. Corn and soybeans, by every metric and commodities as a whole, show evidence that this ended a multi-year bear market here, and we are on a new secular bull market with the first wave up, the first corrective wave, and I believe we'll probably, when these buy signals are taken out in the trend lines, especially this one right here, we'll embark on the next leg up. So it's been setting up. Again, you don't receive a dividend, so you have to be patient. It's all about asset allocation and diversification. So watch those breakouts. That's the thing. If you want to, if you're frustrated that's been moving around, no reason to have a heavy or full position. But once the aforementioned levels, including this 1882 or call it 1900 on corn go, then that might be time to engage. And when you look at, let me show you here, when I go to corn and I overlay wheat on top of it, I think I have it here somewhere. Nope, I'm going to add it here. Let's just make this wheat, W-A-T. Oh, I know where I have it. Right here. I think I already set this up. Yeah, corn versus, so now I go to wheat, W-A-T. Okay, so what I'm showing you here, and this is a weekly chart. I just wanted to show you that they tend to move together. It's still on QQQ. Let's try this one more time. Let's compare wheat and edit chart properties. Okay, had to do a little tweaking there. Now I have it set up. So you can see when I roll from this, the left side, this is where prices are going to sink. Remember, they're priced different levels. Of course, they're two separate commodities, but you can see if you look mainly to the left of the chart, you can come down, you can follow the lines, you can see they move in near synchronicity. And so when one starts to go, the other usually catches up and vice versa. So you can see recently, this is what I wanted to highlight. This is a weekly chart, by the way. I was spanning back decades there. But you can see here that corn has started moving up, and it is in an uptrend where wheat's closer to that low. So I think wheat is poised to close the gap soon. Could go the other way, but again, based on the positive, constructive nature of the charts, I think it'll be wheat kind of closing the gap on corn. I like to spread my bets in the commodities arena. I'm going to get to that next. There used to be a single ETN called JJG that had corn, wheat, and soybeans. Unfortunately, that one, like many others a few years ago, the ETF issuer discontinued. So let's roll into the option I've been talking about. And this is where I have, on my long-term accounts, family accounts I don't trade often, this is where I've had a good position, and I really like the as you know, like the ag ETFs, agricultural commodities for a while. And so what I did yesterday, this is DBA. I've covered it many times in the past, and just to show kind of big picture, here's where it peaked back in 2008, and this was a bear market in commodities. And in particular, these are only agricultural commodities here. So again, you have everything from live cattle, lean hogs, down to corn, wheat, soybeans, and sugar, cotton, all that kind of stuff. And you can see that by every metric, we were in a downtrend, bottomed here with a divergent low, positive divergence. And this is when commodities started to rise. And by every metric, meaning a downtrend is defined as a security making lower lows and lower highs. And when you start taking out those previous highs, which you did there, which you did there, you did there, that tells you you're in a uptrend, and that's what we've been in. So I've maintained for quite a while now that not only was this bull market coming back here, but that we're in one. And now these guys really have outperformed the whole commodities arena as a whole. You can see that they did have, as I expected, this was the initial leg up. Oh, and the primary downtrend line. That was a very well-defined downtrend line for that bear market in the ag commodities in DBA. And that also was taken out. At this point, you can't argue that's not a bull market. We've been rising for, since 2020. Maybe it's over. You can make that case if you want, but it's 112% rise and still going. So let me get back to the daily chart. That just speaks to the longer term, bigger picture. And so back here, what I did just recently, I updated it. You can see a couple years ago, live cattle was the biggest holding at 14% back in early 2019, then soybeans, sugar. So over time, it changes based on the performance of these. And so the reason I like to do this, if you are going to trade individual commodities, be it ETFs, ETNs, or futures, but you have this as a core holding, you need to understand your total allocation. The same way that people that buy Apple stock and NVIDIA, if they've got all their money in the S&P 500 index funds and their long-term accounts or QQQ, they need to know they have severely overlapped due to the heavy weighting in those general index and just about any other growth ETF or mutual fund right now. Okay, so same thing here. Just be advised that cocoa currently, as of the other day, makes up 15.5% of this ETN, coffee 13.5%, live cattle, corn, sugar, and down the line. Collectively, wheat, the one I showed you right here is 5.52%. That's like hard winter red something. That's another wheat contract I don't trade. And collectively, between the two, wheat's like 11%. So now, we're diverging. We had divergence here. I pointed out we did get a correction. So this is an example of a bull market. You had divergence here. You got a correction. You had positive divergence. You had a rally. So these divergent highs typically, especially when trend lines are broken, lead to a correction. But like in most bull markets, those corrections get bought up. So in other words, do you add right now? On the broad base, I'm not as fond. I'm like I said, wheat I'm liking better right now, and corn and the grains. And so I think it's time for them to pass the torch. The things that have held it up, cocoa, I don't know if that ETF trades anymore. NIB, no, cocoa. There used to be a couple. Yeah, they're no longer valid. They're no longer trading. So let's go back to that. DBA. All right, so that's it. And longer term, if it's early stage bull market action, I don't have price targets. It's just a core holding that I'll trade around, micromanage if it gets a little ahead of itself. Divergences at resistance or some of the big commodities in there. I'll look at cocoa futures and all that. What the heavy weightings in here? Coffee. They used to have Joe, and that got delisted. And then the old JJOFF, I think it is. Yeah, a lot of these are gone to the wayside now. Okay, by that, again, a lot of the issuers of these ETNs a couple of years back, one of the big ones just, and that's the signature of a bear market. A lot of ETFs get retired, and the same thing is happening now in reverse. And this is just another signature of where the market is. You see all these proliferation of new ETFs coming out, all these Bitcoin ETFs, and you even have ETFs that literally will only trade NVIDIA, long or short, or some other stocks like that. And again, it's the common signature of a bull market. You have all this issuance, especially these speculative ETFs, and likewise at the end of a bear market, when nobody cares about buying wheat, corn, and soybeans, that's when you want to buy it. And that's when a lot of those ETFs were retired a couple of years ago. So this is coffee, for example. Now, since they're no longer, to the best of my knowledge, an ETF anymore, or ETN that trades it, and you can see coffee kind of had its run. It put in divergence here, at least on the RSI, had a trend line break there, correction one down to this level, and then that divergent high, and then had a second sell signal here, and it broke. This is a failed breakout right there to new highs, multi-year highs, and now it's just cracking below this level. So again, where that plays in is going back to DBA. Coffee is the second largest holding. So would I be adding to or initiating position DBA right now? No. But certainly, like I said, I think some of these others will start to take the reins and move up. Okay, so that's a way to target specifically ag commodities. I've also shared broad-based commodity ETFs, which I also like going forward. The broad-based commodity ETFs will have the agricultural commodities as well as energy. Most of them, be advised that most broad-based commodity ETFs, which track a broad-based commodity index, various ones, but they're usually very top-heavy in energy. So you need to be aware of that when you buy these. For example, DBC, the last time I checked back in 2023, was half in energy. So it had gasoline, WTI crude, Brent crude, New York Harbor, unleaded gas, natural gas, and that made up half of the returns of this one. Then you have precious metals at 12%. Again, be advised, if you have gold and silver, well, you have an overlap here with these broad-based ones. And they're all different. And I encourage you, go to their website, look it up. All their websites, any ETF website will, it doesn't take too many steps to find out what the holdings are. And I always encourage that for proper diversification. Make sure you're not overlapping some other positions. Ag commodities were about 25% back then. So the story is the same as on these long-term broad-based ones who peaked back here in 2008. Remember, the stock market peaked in late 07, but commodities went crazy. Oil went through the roof and everything else, and that was the last thing to fall. Started a big bear market that ended when COVID bottomed the market out in 2020. And then by every metric, including but not limited to the primary downtrend line being taken out and all the previous reaction highs, this appears to me to be the first leg up in a bull market with a first corrective wave with another leg up likely to come. If I am correct on that, that is going to put the brakes on the stock market because that will be inflationary and handcuff the Fed and their ability to be super easy with monetary policy again. If commodity prices fall, goes the other way. That's going to be deflationary, and it will allow the Fed to, or at least give, that part of it should give them some wiggle room there. Commodities are not the only component of the consumer price index or inflation, but they are a big one, and it trickles down to just about all levels. Think of housing, and remember one reason house prices went crazy post-COVID, lumber went through the roof, the cost of nails, labor, everything else. So a lot of the inputs are fall into this as well. All right, so and you can see the downtrend line. So we've got on this weekly chart, you have positive divergence right here on the weekly time frame. There's your divergent low and a downtrend line. You want to zoom down to the daily chart, you can look at it here. I can draw it a few different ways. I can pick it up and do that. Either way, you can see a fairly well-defined downtrend line. And that's just one of them. DJP is another one right here. And you can see, again, it's been slogging around sideways. So if it can break above this recent trading range, that should go. GCC is another broad-based commodity ETF. As is GSG. There's a bunch out there. You pick your favorite. Just know what their holdings are if you're going to diversify. All right, crude oil, I haven't commented much on it lately because it has not been tradable. It's been in a very tight, compressed range. Those ranges don't last forever, but they can last for a while. And so that's why you haven't gotten a lot of updates. But I'll give you crude futures real quick. So for investing or typical swing trading, crude hasn't been very conducive lately. Active trading, yeah, like anything, you can just look for these. This is a divergent high. They're not labeled. They're all the divergences are marked. That was a divergent low. And, and this is it, especially if you can get these divergent highs or lows on pullbacks to support divergent low, rally, divergent high, correction, divergent low, rally. divergent high at resistance correction down to support. So this is the big level. We've been pulling back to about $67, reversed just shy recently, but with positive divergence, been rallying. And then there's this downtrend line. It's I'm not super crazy about it, but it's fairly well defined, and we just took that out. So if crude can start popping, it did pop that previous reaction high. If it can pop that one, you can see this is a potential target up here. But again, it's been in this range here, so I haven't commented much on it. I already covered natural gas, so that takes care of that energy commodity. There's another oil. Well, here is an oil ETN for you. OILK, UGA, unleaded gasoline, same thing. It's going to track mostly crude. Been moving in this sideways pattern. Got a bit of a triangle forming too. So here's a downtrend line, and we're pushing against that downtrend line. If this pops, UGA goes up. That means the price of gas goes up. You've got a nice target right here, 65.52. If that gets taken out, you go to the next level. This would be bearish, a net bearish for the stock market. Again, sometimes the market doesn't get the memo right away, but every tick higher, you start to get back to, remember, gasoline prices, of course, COVID, everything collapsed, but we're hovering now at multi-year highs. We're at the high end of the range, off the highs, of course, but if we get back up here, the market's not going to like that. As I don't have to tell you, gasoline prices permeate just about all facets of the economy, from airline tickets to you commuting to work to the plants making things, manufacturing plants, the energy cost and all that stuff. Energy, there's different energy sources. Not of course, power plants aren't burning gasoline, but they are burning other fossil fuels, and many of which are alternatives to one another. A lot of power plants will switch from coal to natural gas and back and forth depending on prices. UNG, I already covered UNG. I'm just going through my commodities in order. MOO, this is agribusiness ETF. I covered this one back here on a breakout and a back test, and it had another back test. This has stocks. Does not hold commodities. It holds companies that think of Farmer Brown's equipment. You have John Deere, companies like that are in the ag business, not necessarily all farm equipment, but different ones here. And some of those ag input stocks that I've covered recently, there's ADM, Archer Daniels Midland, NTR, one I covered recently with the ag input stocks, Tyson Foods and all that. Or you just go with MOO. This is somewhat dependent on the stock market because these are stocks. However, if agricultural commodities start to go up or continue to rise, I should say, then you may see these go up or at least outperform the S&P 500. And that just means if the S&P 500 goes down, they will probably drop less. The charts are more constructive in my opinion. Wheat, I covered corn, I covered soybeans, I covered cane is sugar. This one had a nice big divergent low here, bullish falling wedge breakout. I would have probably covered it back then. That setup broke out, had a nice ripped up about 15%, is pulled back, consolidated, pulling back, trading on the 200-day moving averages plus support. So you can make a case to go long sugar right here with a stop somewhat below. Somewhat is up to you. If you're a long-term trader, you're looking for a much bigger move up, another leg up, then that's one thing. If you're a swing trader, you probably want to be dealing and analyzing the 60-minute and daily charts there. And of course, if anybody wants, kind of me to mark this chart up, give you a little more targets. There's the next. If we can hold here and rally up, 1419 is my next target. All right, now I'm getting where a lot of these are retired. So you can see these are the old. I used to track these for years, trade these. Sugar, cotton, wood is not lumber prices. It holds the companies that are in the timber and forestry industry and sector. So and as with cut. There's gold, of course, being a commodity. I usually cover gold and silver in a separate update. I've told you recently I don't have a very strong opinion. Gold and silver have been kind of grinding around, as has GDX. We were able to jump in here and swing trade some of these rips and dips. I call it a little upward EKG with divergent highs, divergent lows, especially on the 60-minute chart. But right now, like I said, I just better fish to fry. The charts aren't that clear to me, so. Yeah, staying away from that. I believe that's it. Let me see if there's anything else I want to cover. For you futures traders, since there are no ETFs for this, lean hogs, HE, broke down from this trend line. This is a 6-month, 2-hour chart. Probably going to continue on down to at least this level, maybe more. So that one right now would be more of a seller than a buyer, although I don't have a position in that right now. I don't have a lot of things. I'm coming back from vacation, just try to, and because of the time of year, I'm not crazy about getting too heavy into just about a lot of stuff. LE, live cattle. I haven't checked it in a while. Yeah, I don't have much of an opinion there. There's 101 obscure, futures contracts, OJ, lumber, you name it, it's there. Every now and then I get a request from somebody, some of the folks on the site that trade futures. So let me know if there's a particular futures contract you want me to look at, and I'll be glad to do that for you. Otherwise, I'll wrap it up here and get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.